this education, I'm sorry, I cannot help that. If I would run the program, I would give you full loads of mathematics already on bachelor levels. But I'm not obviously the program manager, but I can only tell you, or I can only encourage you to get the skills by yourself. Yeah? Do it in own responsibility. Buy a good book. There are good books available, I think. Read it, study it for yourself, because later on, when you go to a job interview, the interviewer will not ask you if you got the skills during your education. Yeah, they are not interested in that. They're only interested in what you can do. So I encourage you, get the skills that you need for the job, and that's mainly econometrics and programming. All the other stuff is basically, well, you know. Yeah, so that was that. I'm looking forward to get your feedback for this course, because it will be a little bit different from earlier courses due to this current situation, and hopefully you get the most out of it anyways. So let's get started then with the basics. So just to make sure that all of us are on the same page. Yeah, so we remember from basic classes in finance the capital market theory. Yeah? So, for instance, all of you might have encountered the capital asset pricing model, the CAPM, capital asset pricing model. So in this capital asset pricing model world, say we have n stocks, and that's our investment universe. And just by the way, in this course, you need obviously a pen and paper. So because I will, this space here on the whiteboard is limited, so I will be supposed to take away everything that I write very regularly. So I will clean the whiteboard all the time, and you have to make your own notes at home with a pen and a paper. Yeah? And this is the best way how you learn from my point of view, and that's why I ask you to do this in this course as well. Yeah? It's even an advantage if you have different colors. Also in my course here, obviously I have red, I have black, I have green, blue, so that I can change between colors when I derive things and so on. So to make it more appealing. So that's how the course works. So I will use the whiteboard, you will make notes, and then afterwards you can think about it and you can go through the notes. And if you want, you can even complement your lecture notes. Yeah, you can go through the lecture one more time afterwards, and then you have here the notes in front of you, and you can basically easier follow what's going on here. So once again, so we have n stocks in our stock universe. Yeah, let's denote our stocks, or let's make them here in blue. Yeah, these are our stocks. And let's say we have here on the x-axis the risk, the volatility, sigma, and here on the y-axis we have the return of asset I. Yeah? In our example, we use stocks, but we can also consider other asset markets. Yeah, we know currency markets are also nowadays considered as asset markets, yeah, or bond markets, or commodity markets, whatever. But here we talk about stocks. So we can basically plot them here on a two-dimensional space in terms of risk and return. Yeah, and for instance, this stock here has this risk, and you can here read on the y-axis the corresponding return of that stock. So what's the CAPM then telling us? Yeah? So we have our n stocks, and in the CAPM world, obviously the only thing that matters is risk and return. So you derive the CAPM in terms of their first two moments. The first moment is the sample average, so the return, and the second moment is the standard deviation or the volatility, or you can also say the variance, yeah? Because the variance is just the square of the standard deviation, or vice versa. The standard deviation is nothing else but the square root of the variance. Yeah? So the CAPM tells us then, okay, these our assets, we can compound the mean variance frontier. Yeah? So they span this mean variance frontier. Yeah, we know this. And on this frontier are the optimal allocations of our assets. Also here, what we know is here is the minimum variance frontier. So this combination of asset would give us the minimum variance with this corresponding return here. Yeah. That's the idea of the CAPM. What we also know is once we introduce a risk-free rate, let's say the risk-free rate is maybe here, yeah, here's RF, our risk-free rate, we can, the tangency line that touches the efficient frontier, here, that's our market portfolio, that's our optimal portfolio, our RM. Market portfolio. Yeah? So here we have the maximum Sharpe ratio of our assets. Yeah? So the optimal risk-return trade-off, yeah, we have here. And we know that a rational investor would only invest on this capital allocation line. So this line here is called the capital allocation line, CAL. Yeah? And we know all this already from our bachelor studies. So what you can now think about, so if this is our risk-free rate, yeah, so maybe as a topic for you, if you don't have a topic yet for your master's thesis, or just if you want to think about something else, so what happens if we take our assets as given, what happens if if the central bank changes the risk-free rate? Because this is actually what has happened, right? So we had a risk-free rate from I don't know, 2, 3, 4% many years ago, and now it's basically zero or negative even. What happens to our optimal portfolio? Yeah. What happens? So if we change the risk-free rate, if the risk-free rate, let's say we have it now here, let's call it RF star. And we would plot again the capital allocation line. So our optimal portfolio changes now. Yeah? It changes now to here. This is our previous optimal risk. And that's our previous optimal the return of the market portfolio. And this is the new optimal return of the market portfolio. So what we see is if the risk-free rate goes down, the risk-return relationship of our optimal portfolio changes as well. Both goes down basically. The standard deviation is less, and the portfolio volatility it's less risky, and the return is also lower. How does it affect the risk-return relationship? Who knows? Maybe it doesn't, maybe it does. So that's something that one could think about. So whenever the central bank changes the risk-free rate, something happens to the optimal portfolio, the optimal market portfolio, because it changes where the location of the mean variance optimal portfolio, yeah? Because the capital allocation line changes. Yeah? So that's basically something that we could think about. So if this is the optimal portfolio here, yeah, let's take this away, please. So we can, the capital asset pricing model, it tells you basically that all of our N stocks or our N assets in our universe can be priced according to the exposure towards this market risk factor. Yeah? So it tells you basically that the expected return of the asset I, let's denote R as the return of asset I, is given by the risk-free rate plus the expectation, sorry, we have to include here, of course, the exposure, plus beta I, which is the exposure of asset I against what? Against the market factor, the expectation of the market factor minus the risk-free rate. Yeah? And of course we have a time index here as well, and here as well. So all of our assets are priced according to the exposure beta towards the market factor in excess form. And what we do in practice, if you want to test the CAPM, or if you want to determine the beta, basically what you do is you regress the excess returns of asset I on a constant, let's call it alpha I, plus beta I times the market factor in excess form. And because we run a regression equation, we have to include also here an error term. The error of asset I at time t, epsilon it. So again, we have here on the left hand side the excess returns of asset I at time t, and on the right hand side we have here a constant denoted as alpha, which captures the part unexplained by the market exposure, plus beta I, the exposure of asset I against the market factor, times, so beta I times the market factor in excess form. And because it's a regression equation, we also include an error term. So if we consider the capital asset pricing model, we can also derive, you might have encountered that as well, the so-called security market line. Yeah? So the security market line, SML, so you can basically plot it like this. So you have on the x-axis the beta of asset I, our I asset, and we have here the expectation of the return of asset I. Yeah, so remember now, if we go back to the capital to the mean variance dimension, we have here on the x-axis the standard deviation. But here in this plot, if we talk about security market line, we have instead on the x-axis the corresponding beta. So we then have if we have here the risk-free rate, RF, we can plot the security market line. It looks maybe something like this. So we can read basically if the CAPM is true, if the CAPM holds. If the CAPM holds, we can read the expected return of each asset is depending only on the beta, right? It's because it's only the market risk that matters. For instance, here, if we say here is the beta of 1, then we know we can read here the return or the expected return of the market factor should be here, right? If we have asset, asset K has maybe a beta K, which is here, then we know, okay, the return should be here. Here should be the expected return of asset RK. But what is if asset K has a return that is here? If the expected return or the sample average of asset K is here, what does that mean? So the difference, this delta here, that's the alpha. So the difference between the actual return of our asset K and the predicted return by the Capm, which would be here, that's the alpha. This is the alpha. The delta is the alpha K. And basically, it's captured here in our regression equation, by the constant. That's our alpha. So in other words, this alpha gives us the systematic part of the epsilon. It's the systematic mispricing. If the alpha is 0, it means